You probably think your money is safe in savings accounts or premium funds, but the stability you see on your statements can be a deadly illusion. While most chase high yields, there's a hidden private credit market quietly growing worth over $2 trillion, which could evaporate your wealth without warning. This seems counterintuitive, right? Your safe investments depend on someone else's confidence, and when it disappears, even millionaires feel the chill. Imagine thinking you're secure, only to find out the money you rely on is trapped in funds that can't pay out. While banks and funds freeze redemptions, gold remains liquid, reliable, and universally accepted in any crisis. Its security doesn't rely on promises, contracts, or balance sheets. Experienced investors from old money families to global institutions know this, and now you will too. Get ready to discover how every social class can protect themselves, from reducing debts and holding tangible reserves to sophisticated strategies for preserving wealth. Gold isn't just an asset, it's a survival tool, and the knowledge few share could completely change how you see money and financial security. You've probably heard about the 2008 subprime crisis, but the new risk isn't in mortgages anymore. Today, global private corporate credit exceeds $2.1 trillion, according to the IMF. These loans are marketed as high-yield alternatives for funds and institutional investors, yet they are lightly regulated, highly leveraged, and nearly impossible to liquidate quickly. When liquidity dries up, what seemed like opportunity becomes inaccessible, even for savvy investors. For years, managers could mark assets at theoretical values, creating an illusion of stability. But with interest rates rising to 5% plus, the real value of these credits plummeted. Funds now limit redemptions and freeze withdrawals, echoing the Bear Stearns collapse in 2007. Many investors realize, too late, that their supposedly safe money is trapped. The reality is harsh. While most celebrate high returns, a silent liquidity race is underway. Understanding this dynamic gives investors a strategic edge, while others remain hostage to illiquid funds and unrealized losses. This exposure sets the stage for understanding who is most vulnerable in the next financial collapse. During years of ultra-low interest rates, funds relied on mark-to-fantasy, valuing assets at theoretical prices. This illusion of wealth worked until the market demanded real, liquid prices. In 2024, with rates hitting 5% plus, illiquid assets sharply declined, exposing investors to risks they hadn't anticipated. Funds tried to maintain appearances, but freezing redemptions became inevitable. This mirrors 2007, when Bear Stearns collapsed under similar pressures. Confidence evaporated, panic spread, and investors discovered their money wasn't accessible. The lesson is clear. Paper liquidity is dangerous, and relying on theoretical valuations can be catastrophic when markets test reality. The takeaway is practical. Investors must focus on truly liquid, tangible assets, reconsider exposure to multi-market funds and private credit, and shift wealth into gold, physical dollars, or backed stablecoins. Understanding the difference between illusionary and real liquidity can save significant losses in the coming years. Many upper-middle-class investors are unknowingly financing companies through private credit funds. In 2023, roughly 70% of the U.S. private credit market, totaling over $2.1 trillion, was concentrated in these instruments. Investors think they are earning premium fixed income, but in reality, they are funding unrated or unsecured companies. Exposure is indirect, and liquidity is limited. When the cycle turns, these stable returns become unrealized losses. Redemption freezes or restrictions can last months, leaving investors trapped with illiquid assets. Middle-class savers often discover too late that the perceived safety was an illusion. They assume diversification protects them, but superficial exposure provides minimal defense. The key lesson: tangible liquidity matters more than appearances. Investing in gold, physical dollars, or backed stablecoins ensures you have access to real cash during market stress. This understanding of exposure and liquidity sets the stage for examining the elite who face different but equally dangerous risks. High net worth investors have shifted to sophisticated vehicles like private equity, structured credit, and tokenized real estate. Global private equity alone reached $10.5 trillion in 2023, yet these assets cannot be quickly converted to cash. Lockup periods and complex structures make liquidity an illusion, even for the wealthy. This is why many old money families keep 10 to 20% of their wealth in physical gold completely outside the banking system. Tangible security preserves liquidity when financial markets freeze, offering freedom that paper assets cannot. Gold remains a lifeline when even the most sophisticated financial instruments fail to provide immediate access. Luxury does not equal liquidity. Smart investors combine tangible assets with productive investments like real estate, energy, and food to protect against shocks. Understanding this principle ensures elite families survive systemic liquidity crises while others scramble helplessly. Household debt in the U.S. surpassed $18 trillion in 2024, with credit card and auto loan delinquencies above pre-pandemic levels. When personal credit fails, consumption slows dramatically, and corporate credit suffers from lack of cash flow. This is the beginning of the domino effect in finance. As consumers miss payments, corporate borrowers feel the strain, leading to defaults in private credit and structured funds. Liquidity disappears and confidence evaporates, creating a cascade that mirrors past financial collapses. Investors who ignore this interconnection risk severe losses. Those who understand these dynamics can protect themselves by holding tangible and liquid assets. Gold, backed stablecoins, and physical dollars act as safety nets. Recognizing the link between personal and corporate credit is crucial for surviving the next liquidity shock. When the financial system freezes, one truth becomes obvious: gold is real liquidity. It doesn't rely on balance sheets, central banks, or counterparties. In 2024, during multiple market shocks, gold held its purchasing power while paper assets like corporate bonds and ETFs saw volatility spike. Unlike stocks or private credit, gold is instantly recognizable, universally accepted, and globally portable. The trust in gold isn't conditional. It's centuries old, ingrained in human history, and independent of political or financial promises. For investors and families alike, holding gold means freedom during chaos. While frozen funds leave people scrambling, gold owners can transact, protect wealth, and even seize opportunities. Institutions increasingly recognize this, storing gold as a tangible reserve in vaults outside the banking system. Even fractional ownership through backed ETFs provides exposure without depending on the whims of private credit markets. The key is accessibility and reliability. The lesson is clear: true trust is tangible and portable. While banks and funds can fail overnight, gold cannot. It's a hedge, a medium of exchange, and a preservation tool rolled into one. Whether it's for survival, investment, or intergenerational wealth, those who understand gold's role in liquidity will be prepared when paper assets falter and confidence evaporates across the system. Financial defense starts with planning for what others ignore: liquidity and independence. Low-income individuals should focus on reducing debt and holding tangible reserves in physical dollars, fractional gold, or backed stablecoins. These assets are immediately deployable even when banks or digital platforms fail. Every month, setting aside even a small fraction can create a meaningful buffer for emergencies or opportunities. Middle-class investors must combine caution with strategy. Limit exposure to illiquid private credit and multi-market funds, and maintain 10 to 15% of assets in physical metals or backed ETFs. Diversify further into productive, tangible assets such as real estate, farmland, or renewable energy. These positions provide both cash flow potential and liquidity protection, keeping you flexible when markets tighten. High net worth individuals face similar risks at a larger scale. Storing part of your wealth in gold outside the banking system and investing in productive assets like strategic land, energy, or food security ensures freedom during crises. Even if sophisticated paper assets collapse, These tangible positions remain deployable. Diversification into assets with intrinsic value becomes more than a strategy. It's survival, autonomy, and peace of mind. Quantitative tightening, QT, will push the system toward its ultimate stress test, a liquidity reality check. Private credit and illiquid funds will be tested as central banks face two options: inject capital to maintain confidence or watch credit contracts implode, triggering cascading fund and market failures. Those holding tangible assets, particularly physical gold, will navigate these storms with relative security. Gold has a dual role in this environment. During expansionary cycles, it rises alongside inflation, preserving purchasing power for those who prepared. During contraction, as confidence in credit and banking erodes, gold becomes the ultimate refuge. Investors who recognize this behavior gain an advantage that goes far beyond conventional financial theory. It's real-world protection against both monetary and systemic risk. The coming test will separate the prepared from the exposed. Banks, private credit funds, and complex instruments may fail under stress, while holders of liquid, tangible, and decentralized assets remain operational and confident. Understanding these dynamics now allows proactive allocation, giving you a head start when the market delivers its liquidity reality check. Timing, knowledge, and tangible holdings become the difference between surviving and being trapped. Now that you understand how private credit, illiquid funds, and the illusion of financial safety can trap your money, the question is simple. Are you truly protected? Reducing debt, holding tangible assets, and maintaining exposure to gold isn't optional. It's essential for survival. Every decision you make today can determine whether your wealth is accessible or frozen when the system hits stress. Will you continue trusting banks and complex financial instruments blindly, or will you take control of your liquidity and wealth? Gold, physical dollars, and productive tangible assets provide freedom, security, and peace of mind. Acting now means transforming uncertainty into opportunity and being ready to seize advantage when others panic. If you want to safeguard your financial future and learn how to make your wealth resilient, subscribe to the channel and turn on notifications. Every video will give you tools, strategies, and insights to stay ahead of the market, protect your assets, and never be caught off guard again. The time to act is now. Don't wait until liquidity dries up.